Welcome to the deep dive. We're jumping straight into the latest on the U.S. labor market. We've got the data for May 2025.
Yep, fresh off the press. And we're looking at this through the lens of an analysis you shared, really trying to get under the hood of the jobs report.
Exactly. Because, it's easy to just grab that main number, but the real story is always, well, more complicated.
Always. There's so much nuance packed in there.
So that's our mission today. We wanted to get past that headline figure, unpack what's really going on with jobs, look at the forces behind it all.
And figure out what it might mean for you, the listener.
Right. I always find the jobs report fascinating. It's like taking the economy's pulse, isn't it?
It really is a key indicator.
Okay, so let's start there. The big number everyone saw. The headline, job gain for May.
The economy added 139,000 jobs last month.
139,000. And that was actually, it beat expectations, didn't it?
It did, yeah. Most forecasts were clustering around maybe 125,000.
So on the face of it, that sounds pretty good. Resilience?
That's the immediate takeaway, yes. Employers are still hiring even with all the talk about, economic headwinds and potential slowdowns.
But you mentioned nuance, so what's the catch or the complexity right off the bat?
Well, while 139,000 is better than expected, it is a slower pace of job growth than we saw earlier in the year.
Oh.
So the analysis really flags that. It suggests those bigger economic challenges are starting to bite, even if they haven't stopped hiring altogether. It's a moderation.
Got it. Slower growth, but still growth. Okay. What about the unemployment rate itself?
That held steady, 4.2%.
And 4.2%. Historically, that's still pretty low, right? Considered healthy.
Oh, absolutely. Very healthy from a historical standpoint. No major alarm bells there on its own.
Okay, steady unemployment, slower but positive job growth. But the analysis pointed to something else as being really key here, didn't it? Something beyond the headline rate.
Yes, and this is crucial. The labor force participation rate.
Right? What happened there?
It actually went down, fell to 62.4% in May.
And how significant is that drop? Does the analysis put a number on it?
It does, and it's quite stark. That small percentage drop translates to roughly 625,000 people leaving the labor force in just 1 month.
Oh, 625,000? That's a lot.
Yeah.
These are people not working and not looking.
Exactly. They're not counted in the unemployment rate because they're not actively seeking work.
So why would that happen? What reasons does the analysis suggest for such a big drop in participation?
It points to a few possibilities. You could have more people choosing early retirement, perhaps.
Okay.
Or maybe some workers are getting discouraged, giving up the job search if it's proving too difficult.
Mm-hmm.
And then there are ongoing shifts, things like family dynamics, maybe caregiving needs, making it harder for some folks to stay in or rejoin the workforce.
Right.
It's probably a mix.
That mix of factors. Okay.
Yeah.
Before we move off the main numbers, wages, average hourly earnings.
They were up, rose 0.4% just in May.
And year over year.
Looking back over the last 12 months, the increase is 3.9%.
Okay, 3.9% annual wage growth. What does that tell us? Still a tight market.
It suggests employers do still need to compete for workers, yeah. They're offering more money to attract and keep people.
I sense a but.
Well, it's just that the pace of those wage increases has cooled off a bit compared to the really sharp jumps we saw, say, a year or two ago. It's moderated.
Moderated, okay. So summing up the top line, job gains beat expectations but slowed down, unemployment stable, but participation took a significant hit, and wages are still growing, just not quite as fast.
That's a pretty good snapshot of the headline picture, yeah.
All right, now let's dive deeper. Let's look at the sectors. Where are these jobs actually being gained and lost? This is where it gets interesting.
Absolutely. This really shows the unevenness. Some areas are booming, others are definitely feeling the pressure.
So, who were the big winners in May? Where did we see the most job growth?
Healthcare and social assistance, they continue to be just huge growth engines.
How many jobs combined?
A combined 70,000 positions added in May.
70,000. Wow. And what's driving that relentless demand?
The analysis points to the usual suspects, but they're powerful ones. The aging population needing more care, ongoing public health needs, and just the general expansion of healthcare services.
Specific areas.
Yeah. Hospitals, outpatient care centers, facilities for the elderly, they're all still hiring pretty actively. Demographics are destiny, as they say.
Indeed. Okay, another strong sector.
Leisure and hospitality, that added 48,000 jobs.
Still bouncing back, or is this sustained demand now?
It feels more sustained. It really shows that even with economic uncertainty, people are still prioritizing spending on experiences, going out to eat, traveling, entertainment. That rebound continues to fuel jobs in restaurants, hotels, you name it.
Makes sense. Any other sector showing decent strength or stability?
Construction was pretty stable, kind of steady, unspectacular growth.
Even with higher interest rates hitting housing.
Apparently, yeah. The analysis suggests that non-residential projects, think infrastructure, commercial building, that's providing enough support to keep employment stable there.
Okay.
And education services saw some modest gains, too.
Yeah.
Probably schools finalizing hiring for summer programs and looking ahead to the fall. Seasonal factors there.
All right, so that's the growth side. Now, let's flip the coin. Where did we see jobs being lost or things looking stagnant? This often tells a tougher story.
It really does. And we saw some notable contractions. Manufacturing, for instance, lost 8,000 jobs.
8,000.
Yep.
Not huge, but a decline. What's going on in manufacturing?
The analysis highlights some ongoing struggles. Things like persistent global supply chain disruptions are still a factor.
So, okay.
Yeah. Plus ongoing trade tensions impacting demand and fewer orders coming in from overseas, so declining exports.
Any specific manufacturing areas hit harder?
It mentions machinery, automotive manufacturers, and electronics as feeling the pinch more than others.
Okay. What about professional and business services? That's always such a massive, diverse category.
That one also saw some net job losses, particularly in roles like administrative support and some types of consulting.
What might that signal?
The analysis suggests it could be an early sign of businesses getting more cautious, maybe cutting back on overhead, external services, that kind of thing, tighten the belt.
Right. And retail, always a sector in flux.
Retail trade was basically flat overall, but flat can hide a lot of movement.
How so?
Well, the source breaks it down. You had some hiring in areas like grocery stores, general merchandise retailers. But that was canceled out by job losses in places like department stores and other specialty retail.
So winners and losers within retail itself.
Yeah.
Driven by.
The usual suspects again. Changing consumer habits, the big shift to online shopping continues, and retailers are definitely focused on cost-cutting and efficiency.
Okay, and then there was one sector with a really significant drop mentioned in the analysis.
Yes, government employment. That fell quite sharply in May.
Mostly at what level?
Primarily driven by the federal government. The federal workforce shrank by over 20,000 positions just in May.
20,000 federal jobs. Gone in a month. That's substantial. What's the story there? Budget cuts.
It seems to be a mix, according to the analysis. Budget cuts are part of it, yes, but also hiring freezes in certain areas and ongoing efforts to consolidate agencies or, streamline operations.
Did state and local government see similar drops?
No, interestingly, the analysis notes state and local actually saw slight increases, particularly in education and public safety roles. But the federal decline was large enough to pull the whole government sector down significantly.
And the analysis flags this federal downsizing as a bigger trend for 2025.
It really does. It emphasizes this isn't just a one-month blip. Since January, the federal government has shed nearly 60,000 jobs.
60,000 since the start of the year. Wow. And the drivers. Is it purely about saving money, or is there ideology involved too?
The source presents it as both. There's a fiscal necessity argument, deficit reduction, making government more efficient. But there's also clearly a political ideology component favoring a smaller federal footprint.
But the analysis includes pushback on that, right? Concerns about the impact.
Yes, definitely. Critics worry that cutting staff in key agencies could hurt essential functions. Things like regulatory oversight, being ready for emergencies, or just delivering public services effectively.
And this isn't just abstract D.C. politics. It hits communities.
Absolutely. Many federal jobs aren't in D.C. They're spread out. The analysis points out that communities heavily reliant on those federal jobs can really suffer from downsizing, like the less consumer spending, lower local tax revenues, that kind of ripple effect.
Okay, let's pivot back to wages for a moment. That 3.9% year-over-year increase in average hourly earnings. How does that stack up against inflation recently?
Well, the key point the analysis makes is that 3.9% has generally been running above the recent inflation rate.
So real wage gains for workers.
Yes, on average. That means people's purchasing power is actually increasing slightly, which is good news for household budgets and helps support consumer spending, which of course is a huge part of the economy.
But does that raise the question, could that sustained wage growth potentially fuel inflation down the line if businesses pass those costs on?
That's the classic concern, isn't it? The potential for a wage price spiral. If labor costs go up significantly, businesses might raise prices, leading workers to demand higher wages, and so on. It's something economists and the Fed watch very closely.
So how are businesses actually responding to these higher labor costs besides just paying them? What does the analysis say?
It highlights a definite trend towards investing more in automation and technology, trying to boost productivity and maybe reduce reliance on labor in certain areas over the long term.
Any specific industries leading that charge?
Logistics and customer service are specifically mentioned as sectors that are really fast-tracking adoption of things like AI and robotics, partly to manage costs, partly to improve efficiency.
Okay. Shifting gears slightly to overall business mood. We have positive job growth, yes, but what's the general sentiment among businesses according to this analysis?
The word that comes through is cautious, increasingly cautious.
Despite the hiring, why the caution?
It's a combination of factors weighing on them. Interest rates are still elevated, making borrowing expensive.
Right.
There's still those global trade tensions, creating uncertainty, and maybe a feeling of unpredictability around regulations.
And what does that caution look like in practice? How does it affect their decisions?
Well, the analysis points to slower hiring plans compared to, say, a year ago. Businesses might be delaying big investment projects or scaling them back. There's a real focus on efficiency rather than just pure expansion right now.
Seeing that in specific sectors.
Yeah, definitely. Think about tech and finance. They were huge hiring engines previously. Now, many are tightening their belts. We're seeing hiring freezes, restructurings, even layoffs in some cases.
Policy uncertainty plays a role too, you think?
The analysis suggests so. Businesses might be in a holding pattern, waiting to see how things shake out with, legislative battles over taxes or trade agreements or government spending before they commit to major new hiring initiatives.
Okay, so let's connect this directly to monetary policy. All this labor data, it feeds right into the Federal Reserve's thinking, doesn't it?
Oh, absolutely. This is critical input for them. They have been holding interest rates steady for a while now.
Trying to walk that line.
Exactly. They're balancing this data, which shows a still solid labor market in some ways, against inflation, which has been easing but isn't fully back to their target. So there's this constant debate. Should they cut rates soon to support growth or hold tight to make sure inflation doesn't flare back up?
What are they saying they're watching most closely?
Their focus remains on the key indicators: job growth, wage increases, consumer spending. They're looking for clear signals about which way the economy's leaning and whether inflation risks are truly contained.
It really is a tightrope walk.
It is. Cut too soon, you risk inflation taking off again. Wait too long, you risk tipping the economy into a sharper slowdown. It's a tough judgment call.
So how does this specific May report with its mixed signals play into that? Does it push them one way or the other?
It probably gives them a little breathing room to stick with their current stance, at least for now.
How so?
Well, the continued, albeit slower, job growth and steady unemployment don't scream emergency rate cut needed. But the drop in participation and the moderation in wage growth also don't suggest an overheating economy that needs more tightening.
So wait and see.
Essentially, yeah. They'll be watching the next batch of inflation data, the next jobs report very, very closely. Future decisions really depend on that incoming data flow.
We're also seeing these bigger, maybe more permanent shifts in the labor market itself. You mentioned consumer spending changing.
Yes, that's a huge one. The analysis really emphasizes how the shift towards spending on services and experiences rather than just physical goods is reshaping employment.
So more jobs in restaurants, hotels, travel.
Exactly. And fewer or slower growth in areas like manufacturing or traditional goods retail. It's a fundamental shift in where the demand and therefore the jobs are located.
And the way we work itself is still in flux, right? Remote and hybrid models.
Definitely. The analysis points out how remote and hybrid work have permanently altered the geography of jobs.
How so?
Well, you see workers relocating, maybe to lower cost areas. Commuting patterns have changed drastically. Regional labor markets are impacted differently. Employers, in turn, are widening their hiring searches geographically, but also maybe downsizing their traditional big city office footprints.
And worker expectations have changed too. It's not just about where you work.
Absolutely. The analysis highlights a clear trend. Workers are increasingly looking for more flexibility, better work-life balance, stronger benefits, more autonomy over their work.
And employers are having to respond.
They have to. To attract and retain talent now, companies are revamping job descriptions, redesigning workspaces, offering non-traditional schedules or benefits. It's a real adaptation process.
Let's circle back to that labor force participation rate. It fell to 62.4%, and the analysis called it a growing concern. Why is that drop so worrying, even if the unemployment rate is low?
Because a low unemployment rate isn't necessarily great news if a large chunk of the potential workforce isn't even looking for a job. It suggests underlying problems.
What kind of problems does the analysis point to?
It mentions things like long-term unemployment, where people get disconnected from the job market for so long it's hard to get back in, the trend of early retirements we talked about, and persistent issues around caregiving responsibilities, childcare, elder care that keep people, often women, out of the paid workforce.
Does the analysis identify specific groups facing the biggest barriers?
It does. It specifically calls out women with young children, citing the lack of affordable, quality childcare and inflexible job structures as major hurdles.
And older workers.
For older workers, it's a mix. Some are choosing retirement. Others might have been displaced from jobs and find it hard to get back in, perhaps because reskilling or training programs haven't kept up with how fast jobs are changing.
So fixing this participation problem, it's not simple.
Not at all. The analysis stresses it needs coordinated efforts, things like significant investments in affordable childcare, better access to adult education and retraining, stronger workforce development programs. It's a systemic challenge.
And we've talked about national numbers, but the reality on the ground varies hugely from place to place, doesn't it?
Oh, massively. The analysis makes that point very strongly. The national average hides huge regional differences.
Where's the growth happening most strongly?
The Sun Belt continues to boom. States like Texas, Florida, Arizona, they're seeing really robust job growth.
What's driving that?
It's a combination of factors. People moving there, businesses relocating for lower costs or taxes, big investments in infrastructure. Certain cities in those states are becoming real magnets for jobs and investment.
And the flip side, where is growth slower or even negative?
Parts of the Midwest and the Northeast are facing more headwinds, often dealing with older populations, the decline of older industries, and sometimes people moving away.
What makes a region resilient, according to the analysis?
It seems to be linked to having a diverse economy, not relying on just one industry. Also, strong partnerships between government and private business, and investing in the fundamentals: education, technology, transportation.
Okay, another big trend shaping things is the gig economy. Still growing.
Still expanding, yes. Freelance work, contract jobs, part-time gigs through platforms.
Yeah.
It's a persistent feature of the modern labor market.
Pros and cons. What does the analysis highlight?
Well, the big pro is flexibility for both workers and businesses. But the cons are significant too. Income instability, often a lack of benefits like health insurance or retirement plans, and fewer labor protections compared to traditional employment.
And specific platforms are driving this.
Yeah, things like ride sharing, food delivery, various home services platforms, they absorb a lot of labor, especially for younger workers or those needing flexible or supplemental income.
And that creates headaches for policymakers.
A big one. How do you regulate the sector to provide some security for workers without killing the flexibility that makes it work? It's a tough balancing act.
Is the gig economy influencing traditional jobs too?
The analysis suggests it is. Some traditional employers are adopting more hybrid models, maybe using more contractors, partly to compete for talent that values that flexibility.
Okay, so bringing it all together, looking ahead based on this May data and the broader analysis, what's the outlook? Sunny, stormy, mixed.
Definitely mixed. Delicate balance is probably the best description from the analysis.
Potential positives.
There's potential for positive momentum to continue if consumer spending holds up and if businesses start to feel a bit more confident and maybe loosen the purse strings on investment.
But there are clear risks on the horizon.
Oh, absolutely. Global economic uncertainty is still out there. Geopolitical tensions haven't gone away. Here at home, potential political gridlock, upcoming elections, all these things create uncertainty that can dampen business activity and hiring.
So what needs to happen? What are the key actions highlighted?
For policymakers, the focus needs to be on tackling those structural issues, boosting participation, investing in workforce development and skills training, addressing the regional gaps through things like infrastructure and education funding, maybe finding solutions for childcare.
And for businesses.
They need to keep adapting to what workers want now, flexibility, inclusion. They need to embrace technology strategically and really foster cultures that can navigate this ongoing change. Resilience is key.
So wrapping this up, it's clear the May jobs report is way more than just that 139,000 number. It's a snapshot of an economy in transition, isn't it?
Absolutely. You've got these deep structural shifts happening across industries. You've got this cautious business mood, the Fed walking a tightrope, and just the fundamental ways work is done evolving rapidly.
And the main takeaway from the analysis seems to be,
That adaptation is everything. The path forward really depends on how well employers, policymakers, and workers themselves can adjust to these complex and interconnected changes. The next few months will tell us a lot about whether the economy stays on its current path or if some of these underlying challenges start to bite harder.
so a final thought for you, our listener, to mull over. Given everything we've just dug into, the shifts between sectors, the changing work styles, the stark regional differences, what specific part of this evolving labor market landscape feels most real or most impactful to your own life, your work, or your community right now? Something to think about as we end this deep dive.